So when is the best time to invest or to buy? One might immediately jump to, well, when the market's down, of course. I'm getting a good deal. I'm buying more shares for less money. And yeah, that is absolutely true. We don't always know when that might be or where the bottom of the market is or how far the market will, continue to keep going or when it will bounce back. And I hate to tell you this, but no one can do that consistently over time. It's just not going to happen. There's that old saying that we make plans and God laughs. So is there a way to smooth out that volatility and to lower our purchasing prices over time? And the answer to that is yes, and we're going to get right into it. Hey everybody, welcome back. If I haven't met you yet, my name is Bill Drexler. I'm a certified financial planner. And yes, there is a way to smooth out that volatility, making consistent and even purchases no matter the investment climate, come rain, come shine, how the economy is doing. And that is called dollar cost averaging. So simply stated, dollar cost averaging, or DCA for short, is a practice of systematically investing the same amount over time. It can be monthly, it can be quarterly, it can be annually. And the investor will spread out evenly his or her purchases no matter what the market's doing. The market is up, you buy. The market is down, you buy more. And this is how it's going to work. And I'm going to go ahead and throw a little example here on the screen, and it'll illustrate this a little bit better. All right, so let's say we got a friend named John, and John is 25. John wants to invest, assuming that he has his financial house in order. And if he's been watching a lot of the videos, hopefully at this point he has. So John looks at his budget and he comes up with $100 a month. Okay, I can realistically and consistently put away $100 on a monthly basis, and it's a reliable amount. So we're also going to keep it simple and say that he is investing in stock A, B, and C. And it normally trades, A, B, and C stock normally trades at $5 a share. So it's $100 monthly. ABC's intrinsic value is $5. And let's say ABC trades, and again, we're keeping it simple, in a bear market around $2 a share. And in a bull market, meaning the market's going up, at $8 a share. So with these given facts, normally his systematic $100 a month, let's say, will buy him 20 shares. So if the market is, if A, B, and C stock is behaving the way its fundamentals and its analysis are saying it should, $100 a month buys him 20 shares. In a bear market, meaning that the market is down, his $100 will buy him 50 shares. And in a bull market, when the market is up, his $100 buys him 12.5 shares for the same dollar amount. So as you can see, when the market is down, John is able to purchase more shares, which gives him more of a chance for increase or accumulation. And that's because these shares are trading below their ABC stock's intrinsic value. And I talk a little bit about that in a separate video. I can include that. But that's really where A, B, and C stock likes to trade at. And that's the value where the company's fundamentals, their business practice, their management, the market is saying that that's where A, B, and C should be trading. So aside, if you see a stock trading for far beyond its intrinsic value, that should be an indicator that maybe we should go ahead and get out of this position. And there are several advantages to newer and experienced investors alike. And I'm going to kind of go through some of those advantages for you now too. So the first advantage is that investing is more psychological than we give it credit for. And by making the effort and committing to a certain dollar amount every month, setting it, forgetting it, it eliminates a lot of the emotional biases that we are all subject to. It's done, it happens automatically every month or quarterly, and it eliminates the trap of folks trying to time the market. And I've said this a million times, and I'm sure you've heard other folks say it. It's time in the market, not trying to time the market. And that is because that is a losing proposition. And it's also way more important for our friend John, using this example, it's way more important on how much he's saving. Not necessarily, when he's coming in and out of the market, or even where he's saving. It's how much he's saving, and that's due to compounding interest. And then secondly, it smooths out the cost over time. In our example earlier, you could see an example of that. Eliminating human error regarding ill-timed purchases and sales, and it helps smooth that cost over time. So I hope that this really short, brief introduction into dollar cost averaging was helpful. I myself do that on a monthly basis, have a set amount that goes into investment strategy. It's set, forget it. Not trying to time the market. That's a losing proposition. I think in the next video, I'm going to talk about lump sum versus dollar cost averaging over time. We'll look at a little bit of math, and we'll kind of follow up on this conversation. But I think for now, that's a good introduction to dollar cost averaging. I really hope that this helped. Please like, subscribe, and share. We'll see you in the next video. Until then, be good to yourself and